So welcome, we are in consolidated financial statements, and this is a continuation of previous sessions that we had, and we are now looking at cost of investment. Previously, we looked at introduction to consolidation. We looked at how do we prepare consolidated income statement. We looked at consolidated income statement in different scenarios. We actually looked at around 6 examples of different questions on consolidated income statement. And then we also looked at consolidated statement of financial position preparation in the case of subsidiaries. How do you prepare the consolidated statement of financial position when we have subsidiaries? But so far, we have been assuming that when the subsidiary is being bought, the subsidiary is being bought using cash. In other words, when one company is buying the other, when the parent is buying the subsidiaries, the purchase is through immediate cash. But not in all cases do we have purchase using immediate cash. There are different options that can be used to purchase the subsidiary or any other company. Now, in today's session, we want to explore the different options of purchasing a company. Now, cost of investment is the amount that is paid to acquire this company. Let's call the company a subsidiary. So what the parent pays to acquire the subsidiary, that is what is known as cost of investment. So in our today's session, we want to focus on cost of investment. Let's be very clear on that, what we have for this session. Now, what is cost of investment? So when we talk of cost of investment, this is what you pay in order to acquire another business. What the parent pays in order to acquire the subsidiary. That is what we call cost of investment. What the parent pays in order to acquire another business. That is called cost of investment. Now, this cost of investment is also known as purchase consideration. Cost of investment is also known as purchase consideration. So when we talk of purchase consideration, this is the amount that has been paid to acquire another company. To acquire a subsidiary is what we call purchase consideration. What is paid in order to purchase another company. Now, this purchase consideration, when we have purchase consideration, we can have it in different forms. We have different forms of purchase considerations. How do we purchase a company? We have 3 different options of purchasing. Number 1, cash purchase. Number 2, share exchange. And number 3, through loan notes. Cash purchase, share exchange, and through loan notes. In other words, when you are acquiring another business, you can pay cash. When you are acquiring another business, you can use share exchange, where you give shares in your company in exchange for the shares you are purchasing. You can also use loan notes, where you acquire a loan in another business. So there are 3 different forms of having the purchase. It can either be cash, it can be share exchange, or it can be through loan notes. So we'll be exploring each of these options. However, in loan notes, we had already accounted for them in the last session. When you acquire a subsidiary, as an example, and you also acquire a loan in that subsidiary, when you acquire a loan in that subsidiary, the amount of loan you acquire reduces the amount of purchase consideration. It reduces the cost of investment. For example, if you are to pay 100 million to acquire a subsidiary and you find the subsidiary has a loan of 10 million, you will not pay 100 million. You will pay 100 million less the loan of 10 million that you acquired. So you will pay 90 million. So that's a case of loan notes. So our focus for today will be to acquire through cash and to acquire through share exchange. To acquire through cash and to acquire through share exchange. Now, if we start with the first one, The first one is acquisition through cash. Now, when we talk of acquisition through cash, there is what we call cash payment. Cash payment, there are two options. Either you acquire and make payment immediately, that is called immediate cash payment, or you make acquisition, but you promise to pay at a later date, at a future date. That is known as deferred cash. So where you acquire and you make immediate payment, it's called immediate cash payment. And where you acquire and you promise to pay after a certain period of time, in that case, we call it deferred cash payment. Deferred cash payment. Where you acquire and you promise to pay after a certain period of time, it is known as deferred cash payment. Now, what is immediate? All the previous examples we have looked at are immediate cash. So under cash payment, we have said there are two options, immediate cash or deferred cash. So the first one is immediate cash payment. Immediate cash payment. Now, in this immediate cash payment, you just account for it. It helps you to calculate, number one, the goodwill. Remember, the purchase consideration is used to calculate the goodwill, which will either go to the income statement as an income in the case of negative goodwill, or it will go to the statement of financial position as an non-current asset in the case of positive goodwill. So purchase consideration, which is known as cost of investment, can be used to value the goodwill. Now, that is how we account for cash payment. It is used to value goodwill. So when you have the cost of investment, it is the starting point when you are calculating your goodwill. It is the actual cash amount that has been paid by the business. Now, what about deferred cash payment? When we talk of deferred cash payment, this is where you promise to pay, but to pay at a future date. What do you mean by this? You are acquiring a subsidiary and maybe you don't have all the money that is needed today. So you promise that even though we have agreed on the 1 million to be paid, 100 million to be paid, this 100 million will be paid after 1 year. In that case, that 100 million is known as future value because it will be paid after 1 million. But you must convert it to what we call present value, to know the value of that 100 million in 1 year's time, to know its equivalent value today. The value today is known as present value. So when there is deferred cash payment, in other words, payment in future, you must convert this future value into present value. So by using discounting formula. Discounting formula is normally learned in managerial finance or financial management. So how do we discount? We normally use the formula 1 divided by 1 plus r raised to power n. 1 divided by 1 plus r raised to power n. That is the formula that is used to convert future value into present value. Formula that is used to convert future value into present value. Future value into present value. So we are saying that in deferred cash, point number 1, you must convert future value into present value. Now, this discounted value, the discounted value is the present value, is what you take and use to calculate the goodwill. This discounted value is what is known as cost of control or cost of investment. It is what, really not cost of control, cost of investment. It is what you use to value your goodwill. It is the present value of future cash flows. Now, how do we account for this amount? When there is deferred cash payment, you debit cost of control and you credit deferred payment. You debit cost of control and you credit deferred payment. You credit deferred payment. Now, whenever there is, please, and this is very important, whenever there is deferred payment, because it's a promise to make payment in future, it gives rise to a liability. because you have not yet paid. So long as you have not yet paid, there is a liability until you pay. You make the payment. In other words, there is an obligation until the payment is made. You are obligated until the payment is made. So that is a liability. So remember, in deferred cash payment, until the payment is made, there is a liability because you have just promised to pay and you have not yet paid. Now, this liability can either be current liability or non-current liability. Deferred cash payment can either be current liability or non-current liability. If you promise to pay within 1 year, it becomes a current liability. If you promise to pay within 1 year, it becomes a current liability. If you promise to pay after 1 year, if you promise to pay after 1 year, it becomes non-current liability. If you promise to pay after 1 year, it becomes non-current liability. A promise to pay after 1 year, it becomes non-current liability. Now, because of a liability, think of a loan maybe. A liability, an example of a liability is a loan. There is always an interest that is charged on the loan. Same to this case. Whenever there is deferred cash payment, it gives rise to what we call accrued finance costs. Actually, in consolidation, we call the process unwinding of interest. So in consolidation, this process of trying to find out the accrued finance costs is known as unwinding of interest. So how do we unwind interest? First of all, you calculate the present value of your cash flows by discounting the future cash flows. Once you calculate this present value of cash flow, you take the cost of capital rate, the interest rate that you are given, cost of capital, and you multiply it by the present value of cash flow. We will look at examples. You multiply it by the present value of cash flows. So when you multiply it by the present value of cash flows, that gives you the accrued finance costs. Now, this accrued finance cost increases the amount of liability because we know accrued finance cost is an expense and accrued costs are liability. Accrued expenses are liabilities. So the accrued finance cost increases the amount of the liability. So when I'm showing my liability either as current or non-current, if there is accrued finance cost, this accrued finance cost increases the amount of the liability. It increases the amount of the liability. So accrued finance cost increases the amount of the liability. The third way or the second way to purchase is through share exchange. So we have looked at cash, purchase through cash. We have said it can either be immediate cash or it can be deferred cash. It is very easy to account for immediate cash, but for deferred cash, it results into a liability. You calculate the present value of the cash flows, and then you also do the unwinding of interest by calculating the accrued finance costs. Now, this accrued finance cost increases the amount of the liability, but it is also taken to the income statement as an expense, the accrued finance cost. Because it's an expense, it's taken to the income statement as an expense. Number two, now we are on share exchange. You may be buying subsidiary, and you tell them instead of paying them cash, you give them shares in your company. So parent is buying the subsidiary, but instead of parent paying cash to the subsidiary, the parent decides to give shares in their company. So there is a share exchange. in the acquisition of the subsidiary. Now, how do we calculate the cost of investment in that case? You need to find out the number of shares issued. The number of shares issued. Sorry, you need to find the number of shares acquired, not issued. The number of shares acquired. Sorry. Number of shares acquired times the ratio of acquisition. Through an example, you will know what I mean by the ratio of acquisition. So number of shares acquired times the ratio of acquisition. And the ratio is normally ratio of parent divided by ratio of subsidiary. Ratio of parent divided by ratio of subsidiary. And then times the market price per share of the parent. I'm repeating, to get the value of cost of investment when there is share exchange, you take the number of shares acquired times ratio of parent divide by ratio of subsidiary times the MPS of the parent, times the MPS of the parent. And that will introduce, because you are giving the subsidiary new shares in the parent, it will introduce new shares. These new shares introduced, we will need to consolidate them. So whenever there is share exchange, point number one, you need to calculate the cost of investment. How do you calculate the cost of investment? Number of shares acquired times ratio of parent divided by ratio of subsidiary times MPS, times the MPS. And then we have said, as a result of the share exchange, there will be new shares introduced into the business. There will be new shares introduced into the business. So these new shares introduced, they increase the number of share capital to be consolidated. The third way to acquire a subsidiary to calculate the cost of investment is through loan notes. And in loan notes, I've already explained the process to be followed. So the process to be followed has already been explained. So in the process to be followed, which has already been explained, remember the loan acquired reduces the cost of investment. The loan acquired reduces the cost of investment. We will look at examples. So there is example 5, which we'll look at, because we have covered in the previous sessions, we have covered example 1 to example 4. Cost of investment, I have example 5 and example 6. So we have examples that we will now move to Excel in order to solve the questions. So we have example 5 and we have example 6, which will be the focus of our today's session. And that brings us to the end of introduction to cost of investment. Remember, in cost of investment, number 1, you can acquire through cash. Cash can be immediate cash or deferred cash. Number 2, you can acquire through share exchange. And number 3, you can acquire through loan. So let's just have a small transition. Just a small transition. And then we will start examples. Just a short transition, and then our examples will start.